I didn't do 255. Didn't do too bad, though. Life as I know it is officially over. And let's welcome in the great Kayla Tausche to Street Signs. Kayla.
Hey, Brian. How fast did you actually go in that Bugatti?
I obeyed all speed limits.
All right.
On the Autobahn.
We'll take a look at that later. Right now, you're looking at the markets. Record-setting day on Wall Street. New highs for the Dow and the S&P 500. Breaking above 1,700 for the first time. You can see right now it is sitting just about 4 points above that 1,700 level. The Dow now on pace for its best yearly percentage gain since 2003, sitting up triple digits after a panoply of positive data at 15,626. We want to get down to Bob Pisani at the NYSE. Bob, there's so much to make of today's trade. What are you watching?
It's very simple. We've been promised all year that the second half of the year things will be better, earnings and the economic news. Let's take a look. Well, the most important piece, the first piece of data on the second half of the year, the ISM manufacturing turned out to be pretty good here. Manufacturing is rebounding not just in the United States, but it's also rebounding elsewhere in the world. Look, Europe, U.S. and China. Mr. Draghi said interest rates would be low in Europe for a while. The big issue is, can we take rates over 2.7%? Take a look at that 10-year yield because it's been moving up. And yet the stock market hasn't been falling apart. We're right near the rates we were in the beginning of July. That was a very important level here. Question is, can we take the higher rates? Here's what's going on. Look at the trend that's been happening here. The ADP report on Wednesday came out stronger than expected. Rates are higher, stocks are up. The ISM came out stronger today. Rates are higher, stocks are up. We got a trend. Now how about that jobs report tomorrow? If that comes out a little stronger, what happens? Do we get rates higher, stocks up? Kayla and Brian, if that happens, it's going to convince the markets that that stocks are indeed a little more comfortable with higher interest rates. We're at a very important point in the stock market right now. Guys, back to you.
Bob Pisani. Bob, thank you very much. We agree. And remember, that big jobs number is out tomorrow. Should be a big day to cap off a big week. Well, as hot as the market has been this year, perhaps no group is hot as tech. Many names up high double or even triple digits. But who's been the hottest of the hot? You're looking at the three best performers in the NASDAQ 100. If you're on the radio, here you go. Tesla, Netflix, and Micron Technology. Incredible runs for all. And let's find out if one, some, all, or none of these still deserve your money. Joining us now, Andrea James, Tesla analyst at Daughtry & Company, Barton Crockett, Netflix analyst at Lazard Capital Markets, and Rick Whittington, Micron analyst at Drexel Hamilton. We're going boom, boom, boom. Andrea, let's start with you on Tesla. Why is a stock up nearly 300% this year alone still worth our viewers and listeners' money to invest in?
I think it is. I think it's just a big sentiment shift. People have stopped asking what could go wrong with Tesla, and they've started to ask what could go right.
And what could go so right, Andrea, then? I mean, up 294% a year. Sales, 21,000 cars. You and I have talked about how you value the company, whether it's a tech company or whether it's a car company, because the companies you cover outside of Tesla, Andrea, they're tech. You don't cover GM.
That's right. Right. That's right. So Tesla's, it's both. The car is a platform where Tesla can showcase its technology. And that technology ranges from everything from the thermal management system on the lithium-ion battery pack to the fact that Tesla can push out software updates remotely to the cars that then change the hardware's performance. So the car can improve overnight while you're sleeping. So it is a technology platform on a car. And then they benefit from a technology company cost curve. And that's disruptive in the automotive industry.
Andrea, there's a star stock picker in Boston who recently sold Apple and replaced it with Tesla. This is a guy at Fidelity who has one of the best records on the street. Do you think that Tesla at this point really deserves to be in a portfolio alongside mostly blue chip names at this point?
Yes, because the question, what could go right, is that they scale to more mass market. They have a factory that can do 500,000 vehicles a year, and right now they're doing 21,000. So I think that the answer to that question, it's becoming more clear that a lot of things can go right for them, and they have the technology and the management team and the distribution strategy in place to make those things happen.
All right, Andrea, we'll leave it there. Thank you so much for being with us. We're going to move on now to Netflix. Barton, I'm looking at Netflix right now at 248. It's getting dangerously close to that all-time high of 295. How high do you think it can go from here? What's the story?
Okay, so we're arguing that this is a $325 stock in a year. What we think is happening at Netflix is that you have a company where, kind of like your previous guest said about Tesla, people are asking what can go right. versus a year ago, looking at all the things that were going wrong. What's happening at Netflix is you have a new age TV network company now, which is a high margin business potential. A year ago, people thought of them as a low margin reseller of other people's content, but now they're doing exclusives. They got exclusive deals with DreamWorks and Disney, and they're doing their own TV shows, and they're executing at a very high level. Their fully loaded margin in the U.S. is low single digit, but their peers like HBO are 30% plus margins. I think over the next 10 years, as they continue to kind of get leverage on this content, pull on more subscribers, charge more for it, they can move up towards HBO-style earnings. And the dollar and change in earnings that we see this year could be $10 over the next decade. And that's what people are buying today, and I think there's still more momentum behind it.
Barton, everyone talks about subscriber growth at Netflix, but one of the big problems they have is that people share subscriptions. Do you think this idea that they're making you, within your subscription, create a personal profile and create personal preferences within that, do you think that's the solution to getting people to actually get their own subscription?
You say it's a big problem, but actually the data argues that it isn't. I mean, what happens if a couple of people share a subscription, you end up conflicting and people get bumped out if you go above the 2 or 3 that they limit you to on the standard subscription. But doing multiple profiles, I think, is an opportunity for them to grow their subscriber tally. So, right now they've got great subscriber growth. It's a service that people love.